Is it a worry for those retail investors out there?
Absolutely. And they've been concerned about it for a while. They've been watching rates rise, and they've been hearing the Fed talk tougher about raising rates basically through next year or into next year. So what are they doing? We like to look at what our readers are looking at. And here are some of the top stories, Dom, and some of these may not surprise you at all. How to buy treasury bonds. Our readers are looking that up because finally there is an alternative. We went from TINA, there is no alternative, to TIFA. There is finally an alternative, and that's the yield on some bonds. So they're looking at that. They're looking at how T-bills are taxed. They're looking at the best CD rates. They're finally looking to put money in the bank, basically, because they're getting a little bit more return on those CDs. They're looking for the top 4 government bond ETFs because they want to put money to work, and equities has been no fun lately. And they're wondering what quantitative tightening is. If they don't know, they're going to know by this afternoon. The Fed, of course, selling $90 billion worth a month of government and mortgage-backed bonds now.
So it's interesting, Caleb, because, one of the things I scrutinize, I kind of go through the data that we have at CNBC.com every evening, and I look at what the tickers that people search on our website are. Now, normally there's one important rate, and it's always near the top of the list. It's the 10-year note yield for obvious reasons. People like to, it's a benchmark. Over the course of the last 5 or 6 months, there are now like 7 or 8 different interest rates that people are looking at, including spreads between 2 years and 10 years, 1, 3, and 5, 6-month T-bills. Now they're looking for rates and those types of things. They're looking for 2-year yields and 1-year yields at this point. Interest rates are a huge deal. Will they continue to be, though, with the Fed given its path?
Yeah, I believe so. And I think investors know that pretty well by now. And they're going to know even better by tomorrow afternoon because the Fed's getting more and more aggressive, which is causing our readers, which are retail investors by definition, a lot of them self-directed, to look for ways to either maximize the opportunity with rising rates, protect themselves from more downside in the equity market, or stay on the sidelines altogether. We track anxiety, reader anxiety, through the terms they're searching for. I told you what the top articles were, but anxiety is high, Don. Not as high as it was last year, not as high as it was in 2020, but the concern circles around macroeconomic conditions, right? Are we going to be in this high inflation environment for a while, or is the Fed going to turn this into a deflation or a stagflationary environment and put the economy to sleep for several years? So they're looking at macroeconomic concerns. They're thinking about how it affects them personally. But as I said, they're also looking at those bond ETFs. They're looking for ways to optimize the opportunity for rising rates, opportunistic always, but also fearing what happens when rates rise even further because they know the equity market has been in a spin now since probably the last month or so.
Caleb, we've got a few moments before I let you go. When you look at the readership and the interest, are there stocks or industries in particular that are getting more attention right now?
Yeah, people are looking at utilities. They're looking at the dividend plays because, again, they're looking for opportunity to get some yield out of this, but they're not hovering around their home cooked favorites, which are the big mega cap tech stocks. Those have kind of fallen out of favor right now. They're looking for plays to make money, save money, conserve money, and also get money from those dividends or potentially take advantage of higher yields. So it's very interesting. Even when they're scared, they're looking for opportunities to put money to work, Dom.